This is our Forex blog for February 28th, 2013, and it is the most important blog video we've done in the last 2 years because I'm going to unveil a new feature that we are hoping to release probably no later than tomorrow, and it should transform your trading. If you right click on the chart, you can add what we call the Perfect Oscillator, and it's probably best to use this on the time frame bar that you're using. Eventually I'm going to make sure it works with range bars and tick bars, but until then, since you have 20 layers in our software, you can just put it on a certain layer to take a look at it. And what you want to click on, add script, and what this is going to do is it's going to basically show you how strong or weak the euro dollar is compared to how far it normally moves for different times of the day. And what's really interesting about this is at these extremes, this is basically an oscillator that shows you when the market's up too much or down too much. I find the 80 and minus 80 levels are areas where the market's gone too far and it's likely to reverse. If you look at it throughout the day, you'll see right here a few more bars, it goes up and then it falls. This is the low, and the market goes sideways for an hour. This is underneath the 80 level, and guess what? You know, it rounds out up, comes real close to the minus 80, goes up. Right here, minus 80, guess what? Goes up. Minus 80 right here, guess what? Goes up. And the reason I call this a perfect oscillator is it's based on statistics. There's absolutely zero lag. Every other indicator or oscillator you'll find has tremendous lag. Like, let's go over some of the garbage ones out there, like well, we'll start with the stochastic. That's a pretty horrible oscillator for many reasons. One, you can see it did okay job of nailing the high here. It didn't show an extreme right here. It did show an extreme right here, even though ours was not at an extreme. It showed an extreme up right here, and when ours was anywhere near. It shows an extreme up right here when ours wasn't at an extreme. And you can see it was at an extreme low right here, telling you that the market was oversold and possibly likely for a bounce. And guess what? The market fell off a cliff. And ours was right in the middle, showing you that the market had plenty of room to go. So most oscillators are junk for many reasons, but for one of the reasons, most oscillators use a period. It'll go back, in this case, 14 bars, and do a certain math formula on those last 14 bars. Ours does not use a period for, it analyzes each bar independently of any other bar, so there's no roll-off. A lot of times, if you're, let's say, analyzing 14 bars, if a big move happened 14 bars ago, and then a new bar happens, well, guess what? That big bar is no longer in the 14, and it can affect the indicator. Ours doesn't suffer from that major flaw of pretty much every oscillator out there. And because it has zero lag and doesn't suffer from that mathematical flaw in how they're all calculated, I call it the perfect oscillator. Now, the oscillator value is green, red. If it's above the zero level, the market's likely to be up. Below the zero level, it's likely to go down. And I've also put a 20-period moving average, and I use our digital signal processing based moving average, which is ultra fast. And when it tends to be above the zero level, you're more likely to have uptrends. When it's underneath the zero level, you're more likely to have downtrends. And then I've plotted Bollinger Bands of this indicator. It's not a Bollinger Band of the price data, it's a Bollinger Band of my indicator, my perfect oscillator. Alright, so here's how you use this tool. Clearly, when the market's going sideways, you can use it to, get short at the highs, buy the bottoms, but mainly once you have identified a trend, let's say a pullback like this, when can you look to sell a pullback? There's always trend and counter trend phases. This is the trend phase down. Let's just draw a line. This is a trend, and I'll put trend lines or trends as very thick. This is a counter trend move up, And typically we have two methods of getting into trades. We find a trend and then we wait for a counter trend move, and then we get short on that counter trend move. Well, guess what? Because we have Bollinger Bands of my perfect oscillator on here, it's not always going to pull back up to the plus 80 level, but a lot of times it is going to hit my upper band level right here, and this becomes a place where you can kind of time your entry into, you know, a relatively safer place to get short. This is too soon, this is ideal, and you'll see this over and over again. Okay, so we made a lower low here, and guess what? It came down and hit the lower Bollinger Band level, and it's really close to being oversold. It's pretty much right at the minus 80. So you might want to get out of your trade here and pick up 15, 20 pips if you're a short-term trader. All right, the market comes back up here. It has made a higher high on my oscillator value because the market has really exploded up. So if you sell this area right here, it's not quite at an extreme, but it does has gone above the upper Bollinger Band of my indicator. You can consider getting short here. Now, when the market kind of pulls back and it's not really falling, and you see the oscillator value go underneath 0 and then back up, you might want to get out of your trade with a very small profit, maybe 4 or 5 pips. And it's also a pretty good indication. This is a very classic head and shoulders pattern right here, and also a wedge pattern breakout. You know, the weakness is no longer there, and so it goes up, and you know, this is pretty close to the upper Bollinger Band, so you know, you are trading against the trend of the day. We don't know if it's going to shoot up and make higher highs. If you're not out of it here, when it shoots up again and then comes back underneath the Bollinger Band of my perfect oscillator, you might want to get out of that trade. And then you can also find amazing trades all the time with this, such as a double top right here with a lower high than before. It doesn't have the momentum to continue up, and the trend's down on the day, and you look to go short right here. And you can see when it's underneath the lower Bollinger Band right here, it's probably a decent place to get out of the trade. The market's kind of going sideways. You can see it hit the upper Bollinger level here and the 0 line. The 0 line oftentimes is a support resistance level as well. You go short again, and guess what? It came down and hit the lower oscillator, and you're out. So if you look at that, how many times that happens, it's pretty high probability. And once the market's made a big move down, and you can kind of give it time to go down again. If it doesn't seem to want to go down again, you can consider starting to look for buying the minus 80 levels, such as right here, and again, you know, right here, and for quick little scalps. So let's take a look at some of the other currencies. I'll just do the pound, dollar, and some of the more popular ones. So we're starting the day off, and you know, the market's kind of chopping around. If you notice, every time it hits the upper band, lower band, upper band, lower band, it tends to make a counter trend move. And this is the first instance of hitting really in an extreme move. And the market does try to go up a little bit higher, but basically this is the beginning of the end of that up move, and you know that by looking at it. This doesn't hit the extreme overbought or oversold levels very often compared to the majority of oscillators, which are always giving overbought oversold readings even when it's not true. So you can see that this one, you know, made a higher high right here and had a lower high on the oscillator value. This is called divergence trading. Great place to do a counter trend, and then it goes up again, and not only do we not have the same highs we had before, but it's also at my upper Bollinger Band of my perfect oscillator. So phenomenal pick of the high of the day here. Now you also can improve your odds by using, you know, our other tools such as the daily, weekly, and monthly trend. When you have these on your chart, it's going to add to your probability. You can see that the daily trend was up, but the weekly and monthly trend was down. So if you see any highs of the day and you have any kind of, you know, divergence signals, or it hits the plus 80 level or the upper Bollinger Band, you can consider looking for sells there. And you can see here it's sold off. And another way I've been using this is if the market's kind of dead and then it hits the plus 80 level, well, guess what? This is a big sign that the trend's going to continue up, at least one or usually two more waves. And this is the first time of the day it hit the plus 80 level. Also, if the market goes outside the bands, like it does right here, this is a tremendous sign that the trend's going to continue down, especially since the weekly monthly trend, the longer term trend is down. And you can see it went down another 15 pips. And as it's going down, notice the indicator is actually going up, because while price is making a lower low, the momentum of that fall is insignificant and it's very likely to reverse. And so these are some of the things that you can tell by it. Like notice here, an extreme move outside the bands, that's a trend that's likely to stall, but try to go down one, maybe two more times. Here it goes outside the bands. Guess what? During the pullback, where'd it go? It went up. And that's pretty much how I'm using this. Let's take a look at the euro-yen. Here it goes outside the bands. It also hits the minus 80 level, which is telling you it's kind of oversold, but it's likely to make another wave down. And guess what? It comes up to the upper bands right here. This is where you're starting to look to get short. And it goes up another 10 pips, goes outside the upper level, and then when it comes back into it, usually it's a pretty decent time to start looking for sells. It comes back down, we make a double bottom here, but guess what? We have a tremendously higher low than before. The momentum to the downside's over. Now, when the moving average of my perfect oscillator is underneath the zero line, you can certainly look for sells. So if you got short right here, you can see that the moving average is just about to flip above the zero line, indicating an uptrend. So if you did go short and the market doesn't relatively immediately go your way, probably want to get out of that trade and look to buy a breakout right here. And you can see as it goes up right here, it hits the upper band, longer term trend is down, so you take your 15 or 18 pip profit on here. And guess what? Here it makes a higher high with a lower indicator value, and the longer term trend's down. You might consider selling here and selling here. Notice this explosive move up here. The price, not only price makes a higher high, we go outside the bands. It pulls back. It's not even able to get underneath the zero level. The moving average of the perfect oscillator is above the zero line. You go long. This nice little wedge pattern right here, and the market explodes up. You can see occasionally the market explodes up and then kind of goes a little bit slower to accelerate, and you actually make a higher high with a lower value. And notice how that predicted the next drop. And typically the best way to time it is look for possible support resistance areas and just simply wait for price to break either the previous bar's low or a trend line drawn off the bar's lows. So this perfect oscillator is so powerful that one of the reasons I didn't do a blog video yesterday is I was too busy creating this for the FX Trend Pro. I'm sorry, the FX Trend Intensity. You can see some new indicators in here, and this is what it looked like previously. You have the option now of, and what this does is it statistically compares every euro pair and every dollar pair. What you can do on this now is click on oscillator right here, and instead of showing it as a histogram, it's going to show you what it looks like in the other format. And typically plus 40 and minus 40s for this indicator is when markets are going to reverse. And so as we zoom in on this now, you can see that this is pretty much at an extreme, likely reverse, and it goes up another 5-10 minutes, comes down at an extreme, market goes sideways, and especially at these extremes right here, when it hits the minus 40, guess what? It goes up. And you also have another filter on this, because now you can not only just see the histogram of it, you can see what the 20-period average is of this. And it's not a regular moving average, it's not a simple moving average, it's not an exponential moving average. This uses the digital signal processing based technologies we've put in the software in the last 6 months to average together the previous perfect oscillator values. And you can see when it goes through the upper bands, usually the market's kind of dead. And another thing that this shows you on the FX trend intensity is when the bands get really tight like this, usually volatility is kind of drying up, and you might be in for a significant move. It's showing low volatility when the bands are very tight. And another thing you can use this on is the actual individual currencies. For example, if we put on the indicator showing our indexes, FX currency indexes, this shows, and I'm going to put on star USD. This shows the dollar index. We compare every dollar pair and actually create a synthetic chart of the dollar. And so now you can actually see what the dollar is doing on a chart. The hourly moving average in gray, the 15-minute moving average. You can clearly see highs and lows of the index, and you have when it's above the hourly, it's more likely to go up. When it's underneath the point of control, it's likely to be a resistance area. Once it busts through there, you have a very strong dollar. And this can kind of let you see extremes. Plus 80 levels are usually an extreme. You want to get out, but anytime it hits the anything really over the 40 level, that's a trend that's very likely to continue. So when do you buy the dollar? Well, wait for a pullback, especially when it hits the lower Bollinger Bands of it here and again here, and notice what happens, up. And also when it goes through the upper Bollinger Band of the perfect oscillator and comes back down underneath it, typically it's a pretty decent place to get out of your trade. Wait for a pullback, wait to get in again, and notice how it hit that level here and continued. Now the way we use our indexes is we find one currency that's strong, and this one's confirmed strong really when it hits the plus 80 right here, when it busts through the point of control, and especially when it busts through the previous day's high. You want to find another currency that's super weak to trade the opposite direction. One of them was the Eurodollar today. You can clearly see that this one is underneath the hourly for most of the day. The point of control is right there in the middle. When this has a false breakout from underneath to above it and starts to come back down right here, you can see that's very likely to be a decent place to go short it versus the strongest one, which might have been the dollar at that time. But it also lets you know when to consider doing trend trades. In other words, the trend's down. We may have a move up right here. This this goes above the upper Bollinger right here. And so if you found another currency that was trending up and it had a counter trend move down at the lower Bollinger of the perfect oscillator, you could time those perfectly, and most of the time you're going to catch 15 to 25 pips. I'm going to show this in detail more in the future. This is really an more for experienced professional traders. New traders, you're either going to get this or you're not, but the point is it lets you see things that the price chart doesn't, and it also lets you know when it's relatively safe to get into trend trades. So for example, if the market sells off earlier today with a lot of weakness, comes up to a resistance area, and at that time it's at the upper Bollinger Band of this indicator. The moving average of the indicator is also underneath the zero line, which is dotted gray in the middle. And so, that's a good place at 5:30 to be selling the euro. Let's see if the yen happens to be strong at 5:30. Okay, you can see this one busted through. It made a higher high here, and at 5:30 it had a pullback down. So the yen's very likely to go up. You can see it's right at that level. At 5:30 you almost have a perfect opportunity of selling the weak euro versus a strong yen. So let's take a look at the euro yen at 5:30 this morning, and here is the pullback up. In fact, I'm going to go to a 5R chart, 5 pips per bar, which is one of my preferred charts time frames, and you can clearly see a nice little pullback up right here. And guess what? It falls from around 120.90 all the way down to 60. 30 pip move in 20 minutes when two of our indexes, the yen was very likely to reverse up and the euro was very likely to go down, and this is what you get when you combine them. So it's definitely, if it doesn't make sense now, keep watching our Forex blogs. This is more of an advanced method. Not every tool I come up with is for brand new traders that know nothing. Sometimes I create tools for people who have traded for a decade or two and want to make more money in less time trading.